Carl, great to see you. Thanks for joining us today.
Hey, Carl, what's going on?
So is the take that a couple of 90% up days in a row is actually bullish?
Well, so, I mean, I think the 90% up days and these extreme breadth measures that we've been seeing, that's more a function of just the day-to-day moves in stocks we're seeing are being driven entirely by macro forces. And there's zero to do with fundamental stock characteristics driving market returns. So these kind of extreme breadth readings, cause very, the activity like we've seen the last several days. But going down beneath the surface, some of the technical indicators that we've been looking at are showing some positive divergences here. So for starters, you look at we made a new low in the S&P 500 in the tech sector last week, but the percentage of stocks over their 200-day moving averages and the percentage of stocks making new lows, actually was lower than what we saw in June. So fewer stocks were making new lows. And when you see that type of scenario, it's the idea that investors aren't throwing the babies out with the bathwater anymore. They're becoming more discerning in their sales. And it's not just a all or nothing type of mentality, or it's a less of an all or nothing type of mentality. So those are things to watch. And then you alluded to it earlier as well with the high multiple stocks. Interest rates have been rising, where they were rising up right into quarter end last week. But some of the stocks that have the highest multiples are actually outperforming the broader market here. If you look at the 50 stocks in the Russell 1000 with the highest price to sales ratio, their relative strength versus the broader market actually bottomed in late May, early June. And they've been outperforming ever since then in a pretty steady fashion. So the market looks out, 6 months forward. Maybe that's just an indication that investors are looking to, and you were talking about it in the last hour, not necessarily a Fed pivot, but at least a pause.
Right. I mentioned semis earlier as well. Is that a function of their cycle moving so rapidly and the names having been so washed out this year?
Yeah, so you brought that up as well, and I forgot to mention that. So semis, they've been washed out. They're actually one of the only groups in the tech sector that's trading at a discount to the S&P 500. So the other sectors are still trading at a premium based on their 10-year average. So that's something to think about. And again, what they did last week on a relative basis, semis made a new low, but on a relative basis, their relative strength versus the S&P 500 has yet to take out the lows from, I think for the semis, it was in early July, their relative strength. So, I mean, they got close, but they didn't quite get there. And so as long as that holds something to, as you said, I hate the term cautiously optimistic, but it's a positive divergence that the market is telling you something that maybe the headlines aren't telling us.